Welcome today to our seminar on information reporting. Specifically, the seminar topic today is understanding and preparing for filing and furnishing forms 1094C and 1095C. My name is Susan Grassli. I'm an attorney here at GBS, and I am the one who helps you understand and get educated on all things Affordable Care Act. So today our agenda will be as follows. I'm going to give you a short introduction and then an information reporting overview that kind of affects everything to do with information reporting, and then we'll dive right into line by line into Form 1094C and then Form 1095C, and then we'll finish up with next steps for employers. So first of all, it's important to understand the basic parts of the ACA. First, there's individual shared responsibility provisions, employer shared responsibility provisions. Both of these are sometimes referred to as individual mandate and employer mandate. And then exchanges, also referred to as marketplaces, and the subsidies that some individuals and families will qualify for. And then finally, market reforms. Now, the individual shared responsibility, employer shared responsibility, and exchanges are sometimes referred to by me and others as the big three. And that's what we are going to be focusing on today. Market reforms won't be part of our discussion, but please understand there are other provisions under the ACA that are very important for you to follow as well that fall under market reform. So please come attend our seminars on those topics as well. So what is information reporting? Basically, the Affordable Care Act requires the IRS to regulate and determine penalties under these three parts of the ACA, specifically the individual mandate, the employer mandate or individual shared responsibility and employer shared responsibility, as well as issues dealing with the exchange and marketplaces. So the ACA requires the IRS to determine whether there are subsidies in the exchange should or should not be provided, and it requires them to sort of be in charge of this part of the ACA. So to regulate these provisions, the IRS needs to know whether individuals have health coverage for themselves and their dependents. If they don't, they may have to pay an individual mandate penalty. They also need to know whether individuals who obtain coverage in the exchange and marketplace really should have gotten a subsidy, and if not, they may have to pay that back. And whether large employers owe an employer mandate or employer shared responsibility penalty. And those penalties are officially referred to as the 4980HA penalty and the 4980HB penalty. I refer to them as the non-offering penalty and the minimum value or affordability penalty. These forms that the IRS created provide the data and information they need in order to make the determinations they need to make. Now, as well as IRS, we know that Health and Human Services and Department of Labor are also help regulate and have regulatory authority over the ACA as well. But for this specific issue, the IRS is sort of the one leading the charge. So, information reporting overview. That was our introduction. Now let's go and talk about a few things that have to do with information reporting in general, and then we'll talk details line by line in the specific forms. So, who actually reports health coverage information to the IRS? There are lots of entities that will be doing this. We have the exchange, AKA, or also known as the marketplace. We have carriers, the insurers. We have large employers. We have certain small employers. And specifically, there are small employers that sponsor a self-insured plan, or small employers that are part of a controlled or affiliated services groups, or also known as aggregated groups. So the total number of the aggregated group is greater than 50. And then we have individuals who also actually are taking part in this reporting process. What are the forms that are used to report? Well, we have a few different forms. We've got Form 1094, but if you'll notice carefully, there is a 1094B form and a 1090C form. So you need to pay attention to what letter is attached to the end of that 1094. There's also a 1095 form, and there's a 1095A, a 1095B, and a 1095C. And then, of course, there's the form 1040. That's the form that we all use at the end of the year or the beginning of the following year to fill out our individual taxes. So, who uses what forms? The C-Series forms I have listed at the top because those are the forms we're going to be talking about today, because those are the forms that large employers are going to be filling out. So forms 1094C and 1095C. The B-Series forms are for carriers, also small employers with self-insured plans, and technically they're also for large employers. However, there's a special section on the C forms for large employers to fill out if they're self-insured, so that they don't have to also fill out the B forms. So again, on the C series forms, large employers who are self-insured or sponsor self-insured plans have a special section that is the equivalent of the information requested in the B forms. So oftentimes you hear that large employers have to do the C and B forms, but in reality all you have to worry about is the C forms, because there is a section that requests the B form information. Also, we have the A-Series form, which will be completed by the exchanges and marketplaces. And then we have individuals, again, that complete 1040s every year. All of us do, so that we can, when we turn in our individual taxes. Individuals also may be receiving A, B, and C forms, depending on who they are. And they may need to complete some extra forms this year due to the Affordable Care Act, which is 8962 if an individual got a premium tax credit, and 8965, which is a form used for individuals who did not get coverage for themselves and their dependents, but feel they fall under an exemption to the individual mandate and therefore would not have to pay a penalty. So here's our graphic to kind of give you the big picture that we were just discussing. You'll notice on the left-hand side we have exchange and marketplace, and then we have an arrow that says 1095A that goes to enrollees. Every enrollee in the exchange and marketplace will get a 1094A. In the middle we have providers, and the small self-insured plans fall under this plan. They will be filling out the B forms. The 1094B goes to the IRS, and the 1095B goes to all enrollees. And then we have large employers on the right. We have who will be filling out the 1094C that will go to the IRS, and then individual 1095Cs for all of their enrollees. So you can see that an enrollee could be getting more than one form, but all the forms that go to the enrollees are the 1095s, and all the forms that go to the IRS are the 1094. So our discussion today is focused only on the C forms. So if you have information you want about the B forms and the C forms or anything else, we won't be able to cover that today. Let's first talk about the C forms and who specifically is a large employer. A large employer is defined as 50 or more full-time employees plus full-time employee equivalents. Now, I'm not going to go into detail today about how you calculate a large employer. When you have our 4 steps, we have a 4-step process for you to go through in order to determine your compliance with employer shared responsibility. When you go through those steps, the first step is determine your size. We go into great detail about how you actually calculate your size. You're not just saying, oh, we've got 45 employees and that's what our size is. No, you have to actually calculate your full-time employees plus figure out your full-time employee equivalents, and there's a special calculation for that. You do this on a monthly basis and then average over the calendar year, and you do it based on the prior year, and there's all kinds of rules about it. So if you do not know for sure whether you are a large employer, and for whatever reason you haven't yet gone through our step 1 or our 4-step process, and specifically our step 1, you'll want to contact us and say, I need to get going on those steps. The C-Series forms, like we talked about in the graphic just before, the 1094C is filed with the IRS, and the 1095C is furnished to employees, an individual one for each employee. that is supposed to get one, and copies of those are also sent with the IRS. So which employees get the Form 1095-C? Well, it depends. If you are sponsoring a fully insured plan, your employees who are full-time get those forms. And when I say employees who are full-time, it may include employees who you don't consider full-time. In other words, if you have an employee who works 130 hours or more in a month, that employee is, under Affordable Care Act, full-time. So even though that employee may or may not be eligible for coverage, you would still need to provide a 1095-C form to this employee because they were full-time for at least 1 month in the calendar year. If you sponsor a self-insured plan, the same rule applies to you, full-time. Anybody who is full-time or 130 hours or more per month, at least 1 month in the year, plus any other employee who is offered coverage and actually enrolls. In other words, some of you who are more generous than the minimum requirements under the ACA and offer to more employees than those who work 130 hours or more average in a month, may also offer to those who work 120 hours in average or 100 hours average or whatever. So if you are like this employer and you are self-insured and you have anyone who actually opts into that coverage, you also need to give them a form as well. When are the forms due? I'm going to give you the general rule, and then I'm going to give you the rule for this year. Generally, the 1095-C is due to employees at the end of January every year, January 31st. If it falls on a weekend, it's going to be February 1st, or whatever day is the following Monday. The 1094-C forms, the ones that go to the IRS, plus copies of the 1095, are due February 28th, or the end of February. If it happens to be fall on a weekend, then it would be the following Monday, whatever that date is. For 2015, we have a slightly different, well, it's not so slight anymore. We have a different deadlines. On December 28th, the IRS extended the deadlines for a few months. In other words, the 1095-C, the one that goes to your employees, was moved from February 1st because it fell on a weekend, because the 31st fell on a weekend, to March 31st. So you have until no later than March 31st to get those 1095-Cs to your employees. The 1094-C, plus all copies of the 1095-C that go to the IRS, are due May 31st if you're not filing electronically, and are due June 30th if you are filing electronically. And we'll talk about who is required to file electronically versus who can do that voluntarily when we get a little further into the presentation. So this has been an extremely common question we've had since the extension of the deadline for reporting was extended. What if my employees do not receive our Form 1095-C in time for them to file their individual taxes? Because, of course, before the deadline was the end of January, and now it could be the day before or just right before the final day for tax submitting your individual taxes. And some of your employees, many of them, will want to file long before you get them the 1095-C if you didn't get it to them already. So here's the rule, and here's the explanation of this. Due to the extension, the IRS, this extension that was on December 28th, the IRS says it is not necessary to wait for the 1095-B or 1095-C forms to file individual taxes. Instead, individuals may rely on other information, quote unquote, to prepare the tax return. So the first question then is, well, what is other information? Well, other information has now been defined as things like insurance cards, explanation of benefits, statements from your insurer, W-2 or payroll statements reflecting health insurance deductions, records of advance payments of the premium tax credit, or other statements indicating that you or a member of your family had health care coverage. Now, so we now know what other information is, and we know we don't need to wait for the B or C forms. But once they receive them, do they need to attach, or do they need to attach the other information to their when they're submitting their individual taxes? No. The answer is no. And if the individuals do not need to attach other information, quote unquote, nor do they need to attach any 1095 forms to the return, even if you provided to them on time. Instead, the form should be kept with individual tax records. So the analogy to this is the W-2. A lot of times now when you're filing electronically, you don't have to actually attach or submit the W-2 to your individual taxes, at least when you're filing electronically. It's the same idea here. You keep that information in your records, but you don't actually attach it. So that's great. So you don't have to, your employees don't have to be concerned about that. If there is an exception, if an individual is expecting to receive a Form 1095A, this is the one that comes from the marketplace or the exchange because they purchased health coverage in the exchange, they do need to wait to file their individual taxes until they receive that Form 1095A. Now that deadline was not extended. That deadline was still February 1st. So anyone who received this coverage in the exchange should have already gotten their 1095A. But still, it does not need to be attached to the actual individual taxes. It's just kept in your tax records. Now, GBS created a letter that you can edit to use as you see fit to provide to employees that explains all this, like, you know, my tax preparer says I have to have a B form or a C form, blah, 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 and you can send this, give this to them, or just send it out to all of your employees if you want. If you would like a copy of this so that you can edit it and use it as you like, please contact us and we'll get that to you. So the other information that's important for you to understand here is that there is no transition rule when it comes to information reporting. That means that all employers who in step 1 of our 4 steps determined their size and their size was 50 or more has to report for 2015. In other words, in our step 2, you're determining your effective date. In other words, when you are exposed to penalties under employer shared responsibility. And in step 2, many of you are not exposed to penalties on January 1st, 2015, and some of you are later in the year of 2015, and some of you are in 2016. That transition rule under employer shared responsibility that allows you not to be exposed to employer shared responsibility penalties until that effective date does not apply to information reporting. In other words, even if you're not exposed to penalties till later in 2015 or until 2016, you still have to report for the full calendar year of 2015 if you are 50 or more. Okay, so the reporting methods. We're going to spend a little bit of time on this, and we've got a few slides, and it gets a little bit confusing, so bear with me and don't get frustrated. You can also re-listen to this if you need to, but we have in the rules various reporting methods. First of all, we have the general or full method. That just simply means that when you fill out the forms 1094C and 1095C, that you need to fill out all lines and all columns. You don't skip anything. There are also, and that's fine, you certainly can do it that way. There are also a few alternative reporting methods in which you are allowed or excused from filling out a certain line or a certain column, or depending on what the method is. So the alternative reporting methods are qualifying offer method and 98% offer method. We also have one that is just for this year called the qualifying offer method transition relief for 2015. Now, again, the alternative reporting methods are not required. They are optional. So there's no need to worry if you don't qualify for one of the reporting methods. You may opt out of the alternative reporting method even if you qualify for one. And you may use on the 1095C alternative reporting for some employees and general reporting for other employees. So hopefully that's clear now to you. Why would an employer want to use an alternative reporting method? Well, under all methods, whether it's general, full, or alternative, you still have to complete both the forms, the 1094C and the 1095C. Originally, we were thinking, well, does it excuse them from doing this at all? But what it does excuse you from is that you are excused, like I indicated before, from a specific line or a specific column on one of the forms, and these specific lines and columns are kind of a pain to have to populate because of the information you have to gather. So we'll talk about that more in detail in a bit. So here's the first alternative reporting method, the qualifying offer method. So first of all, we have to understand what a qualifying offer is. A qualifying offer is a specific kind of offer that is stricter than requirements under employer shared responsibility. So if you have an employer shared responsibility plan or a plan that complies with employer shared responsibility, it may still not be a qualifying offer because it has stricter requirements. So let's talk about that definition. First of all, the offer needs to meet minimum essential coverage, or MEC, for employee, dependents, and spouse. Under an employer shared responsibility compliant plan, you don't have to offer to the spouse, but under a qualifying offer, you do. Second, minimum value, or MV, for employee. It doesn't necessarily have to meet minimum value for dependents and spouse. It likely will, but it doesn't have to. Third, your affordability safe harbor is a federal poverty level. In other words, when you are working on step 3 in our 4-step process, you go through and learn about the affordability safe harbors, and that there are 3 options you can choose under employer shared responsibility: federal poverty level, rate of pay, or W-2. That is allowed under employer shared responsibility, but a qualifying offer under information reporting rules requires that you have chosen the federal poverty level safe harbor and not one of the other 2. Or at least, if you didn't choose that federal poverty level threshold, at least you are under, for this particular individual on whom you're reporting, the monthly premium threshold for federal poverty level. It also needs to have been offered for all calendar months all months of the calendar year for which the employee was full-time. So we now know the definition of qualifying offer. Let's talk about how you use the qualifying offer method. You may use this method only for an employee who had a qualifying offer, right? So somebody who received an offer that was just like the above, or at least minimum of the above. And if so, you are excused from filling out line 15 on the Form 1095-C. Now on the next slide, I'm going to show you what line 15 on 1095-C looks like. But first, let me tell you what the other thing you might be excused from. In certain cases, you might be excused from providing this 1095-C to the employee altogether. Now, instead, you must provide them with a statement in lieu, or basically a letter, instead of the 1095-C. Before you get excited about not having to fill out a 1095-C form to your employees, please understand that you still have to file a 1095-C with the IRS. So if you choose to do a statement in lieu, you still have to prepare and populate the 1095-C form and give it to the IRS for all of your individual employees that you have to report on. So unless I'm missing something, it makes sense to just go ahead and not do a statement in lieu. So like I promised, this is what the 1095-C form looks like, and this is the line that's highlighted that is line 15 that you may be excused from completing if this particular individual for whom you're filling this form out has received a qualifying offer. Here is the statement in lieu of furnishing a 1095-C to the employee information. This is information in case you decide you want to do this letter or statement instead of giving them the 1095-C, and here's the rules for that. But I'm not going to spend time on it because I don't think many of you will be doing it. If you decide to do it, feel free to email me and ask me some questions about it if you need help with that. So that was our first alternative reporting method. Our second alternative reporting method is very similar to the first one. It's called the Qualifying Offer Method Transition Relief for 2015. This is the same definition and general rules apply as a qualifying offer method. In other words, you need to have offered a qualifying offer, and if so, you are excused from filling out line 15 on Form 1095-C. And then, of course, in some cases, you're excused from providing the form at all, and instead doing a statement in lieu, but you still have to provide the 1095-C to the IRS, so why not just do the 1095-C to the employee? So far on this transition relief, it's exactly the same as the qualifying offer method, because you're excused from line 15, which is what most of you would be dealing with. So how does this differ from the regular qualifying offer method? Well, employees who receive a qualifying offer need not have been offered for all 12 months of the calendar year. Employees just need to have been offered a qualifying offer for at least 1 month. In other words, even if this individual doesn't get a qualifying offer for the first 5 months of the year, you can still use this method. So how do you use this method? What are the additional rules? You can use this method if you provide a qualifying offer to at least 95% of your full-time employees. If you provide a qualifying offer to at least 95% of your full-time employees, normally for the other 5% who didn't get a qualifying offer, you would have to do the general method, and when you fill out the form for those 5%, you'd have to fill out line 15. However, this transitional relief method allows you to skip line 15 even for that 5%. In other words, if you, again, offer a qualifying offer to at least 95% of your full-time employees, you can skip line 15, not only for your 95% of your full-time employees, but also for the 5% who did not get the qualifying offer. And here again is the 1095-C form, line 15, which is highlighted, which is the line that you're excused from. And here's the statement in lieu of furnishing the form to the employee, which I don't know many of you will be taking advantage of, but here are the rules in case you do. It's slightly different, and the statement is slightly different if you decide to do this. Okay, our last alternative reporting method is called the 98% offer method. And the definition of this offer, what needs to be offered to employees in order to use this method, is different. It's not the qualifying offer definition. It's actually more lenient. It's actually identical to a plan that's compliant with employer shared responsibility. So again, an offer under this method is the same as a compliant offer under employer shared responsibility. It's not as strict as a qualifying offer. So in other words, you need to have offered the minimum essential coverage to your employee and their dependents, but there's no need to offer to the spouse. The offering to the employee needs to meet minimum value, but it doesn't have to meet minimum value for their dependents and spouse if you offer to them. The affordability safe harbor that you use can be any of the 3 safe harbors, which is the W-2 method, the rate of pay method, and the federal poverty level method. And affordability only needs to apply to single coverage. It doesn't need to be affordable for dependents and family. So that's what needs to be offered under the 98% offer method. So how do you use the 98% offer method, and what does that get you? What is the carrot? So this is how it works. Of the employees on whom the employer must report, in other words, the ones you have to give the 1095-C form to, 98% of those must have been offered an employer shared responsibility compliant plan. In other words, it meets the above. So how do you calculate 98% of your employees that should have been offered, your full-time employees? Well, when you're calculating the 98%, you do not have to include employees who do not need to receive a 1095-C. In other words, you don't have to include employees who are not eligible or full-time under the rules. You also do not have to include employees who are in a limited non-assessment period. We're going to talk in more detail about what a limited non-assessment period means in a little bit, but for purposes of right now, I'm just going to tell you that that's kind of like an employee who's in a waiting period, who's eligible after their waiting period. So you also can in this 98% calculation include employees who are not full-time but who are offered coverage. In other words, you're more generous than the minimum rules under the ACA, employer shared responsibility, and you offer to those who work less than 130 hours per month, maybe it's 120 or 100 or whatever, and they get offered coverage. You can use those employees in your 98% calculation. If you qualify for this, and if you want to use this method, what are you excused from? Well, you're excused from reporting your monthly full-time employee count on the 1094C, which is what we're talking about now, the 1094C. Well, we're not talking about it yet, but we're going to on the line by line. Part 3, line 23, column B, which will not mean anything to you now, but it will in a little bit. But let me show you what it looks like. So part 3, this is actually part 3 of the 1094C form. Remember, this is the one that goes to the IRS, and under column B, which is highlighted, it asks you to provide a full-time employee count for large employers. That's what ALE member means. So it's basically you're counting full-time employees each month. Now, please understand that this is more complicated than you think, because I will have employers say, oh, well, that's not that big of a deal to figure out. I'm using the look-back measurement method that I created and I put together a policy in step 4 of our 4-step process. And I'm tracking hours for 12 months, and I'm averaging their hours over that 12-month period to determine who's eligible for coverage. Well, that's great. You need to do that under employer shared responsibility, but for information reporting, you don't get to average your employees' hours. This is a monthly count, so you are not using the look back to calculate this. It's a separate type of tracking. So for example, for January, you would just simply put the number in here that includes every employee who worked 130 hours or more per month. So this could include somebody who's in the look back and doesn't actually qualify for coverage after the 12 months and you average, but they are full-time in that particular month. Or it could include somebody who's full-time seasonal who wouldn't end up getting offered coverage because of the exceptions, but you need to count them in this count. So again, the idea behind this is, and what I need you to understand, is it's a separate tracking process than the tracking process under look back under employer shared responsibility. So those are the 3 methods. So now we're going to talk about something a little easier for a minute to kind of take a break from that sort of technical detail and talk about how you actually file the forms with the IRS. First, we're going to talk about how you file the 1094C forms plus the copies of the 1095Cs with the IRS, and then we're going to talk about how you furnish or provide the 1095Cs to your employees. So the 1094C goes to the IRS. If you are not filing electronically and you're shipping and mailing to IRS, you need to put the forms in envelopes where they're flat and not folded. You may use more than one package to put the forms in, but they need to be numbered consecutively, and you need to use or send first-class mail. Where you mail to the IRS depends on which state that your principal business is located in. For those of you whose principal business is located in Utah, you're going to be going or mailing to the Department of Treasury IRS Center in Kansas City. So just put a star by that. The extension of time to file the 1094Cs that was in the instructions and the rules is no longer in existence anymore because the IRS already extended the deadline. So don't think you can ask for an additional 30 days beyond the new deadline. That just has gone away completely for this year at least. Filing with IRS electronically. Let's talk about that for a second. You are encouraged to file electronically and not required. You are encouraged to file electronically if you are filing less than 250 1090C forms. However, you're required to file electronically with the IRS if you are filing 250 or more 1095C forms. So in other words, if you have to prepare at least 250 1095-C forms you are required to file electronically. The electronic filing procedures can be a bit cumbersome, but you need to be aware of them. You need to file through the IRS system called the AIR program. The AIR stands for, or is an acronym for, Affordable Care Act Information Returns Program. If you are using a vendor or a third party whom you have hired to help you do the submission, either populating the forms and or the submission, the vendor will become an authorized e-filer or transmitter through the AIR system, and you don't need to worry about going through this process. I would, though, however, make sure you communicate with your vendor to make sure that you are on the same page and you understand what they will or will not be doing for you. I know that's been a bit of an issue with some who haven't communicated completely and have discovered that their vendor is not actually submitting the forms for them. They're preparing them, but then expect you to submit them. So make sure that you're clear on what your vendor is or is not doing for you. If you're not using a vendor, or if the vendor is not filing the forms for you, you must use the AIR program to become a transmitter. This is a process to go through to become a transmitter. There's actually 3 stages of this process, and maybe I should add it to my PowerPoint or presentation so that you can see it. But we do have, and here listed here are IRS publications that explain that. But we have prepared, it's a new document that was for February 2016 that goes through in more detail the 3 steps that you need to go through and helps you sort of understand, like, for example, am I an issuer or am I a transmitter, or how does that work? You'll know what I'm talking about if you've tried to get on and try and figure that out. But we have created a document. Please ask for it if you are interested in reading it. It's a document that talks about it's a February 2016 document. It says it's about reporting and filing for through the AIR system and what employers who have to do that need to know. So ask us for that and we'll forward that to you. There are waivers from electronic filing generally. Electronic filing, not electronic filling. Sorry about that misspell. So to get a waiver from the electronic filing requirement, you need to submit Form 8508, and you must submit at least 45 days before the due date of the returns. If for whatever reason you think you need to ask for this, I'm not sure what the process is in order to get a yes to that, but if you don't get a waiver and you are supposed to submit electronically, penalties may be assessed just for not filing electronically. So you want to make sure that you do that if you are required to. So we just talked about how to file with the IRS. Now we're going to talk about how to furnish or provide the 1095-C form to your employees. Generally, you are allowed to give to your employees this form by mail or in person or electronically. If you're furnishing by mail, make sure you mail to the person's last known permanent address. Please also know that you may place in the same envelope as the Form W-2 the 1095-C form. Now, at this date, since we're in February of 2016, you would have already sent out your Form W-2, but no, for future years you can do that. If you want to furnish to your employees electronically, you may do so, but you must obtain consent from each employee before you do that. So make sure you get consent. The extension of time to furnish the 1095-C to employees that was a 30-day automatic extension, sorry, it wasn't automatic, you had to go through a process, no longer exists because the IRS has already extended the deadline a few months, and this deadline is longer than this 30-day extension would have been. So you don't get an additional 30 days beyond the new deadline, so make sure you're on time. Now, I'm not going to spend a lot of time on this. This is just to give you an FYI that the IRS expects you to self-correct returns on paper forms if there is a need to. Right now, I just want you to figure out and learn how to get these forms filed, but know that if you are aware of a correction that needs to be made, there is a process. Here is a summary of the process, and you'll want to do that without somebody catching you and telling you you have to. So what creates a possible penalty? Well, there are several penalties that may be assessed under information reporting, just like there are some penalties under employer shared responsibility and the 90-day waiting period and the MLR reporting rebates and all the other provisions of the ACA. So information reporting does come with penalties, and we've already talked about one, which is if you fail to file electronically and you were supposed to, there's a penalty. If you look to the bottom of this slide, if you fail to make a good faith attempt to complete the forms accurately, you get a penalty. If you fail to file timely or on time, especially given the extended deadline, there's a penalty there too. So there is transitional relief for this year only, which means basically that the IRS will not be doling out penalties for those who make a good faith effort to comply this year, even if they have incorrect or incomplete information on the forms. This is not a reason to say, oh, I'm just going to not try very hard and I'm just going to throw some forms in there and be done, because you do actually have to show a good faith effort, and there's specific rules about what you need to do in order to show good faith. So make your best possible effort in getting these forms accurate, and then learn from that, and don't worry about being hit up with a penalty, at least this year. So here's a slide showing what the different various penalties could be under information reporting. But also I want you to see the two columns that say new amount and old amount. This is just an illustration of the increase in penalties that the IRS announced. If you look at that top line or top row, the old amount for failure to file or provide to an individual was $100 per form. Now it's up to $250. So just be aware that there are some significant penalties that can apply to just information reporting. Okay, so we've done our introduction and our overview, and now we're going to dive right into the actual form, the 1094C form, line by line, so you can hopefully completely understand what you should be doing. Okay, so here's our overview. Part 1 of the 1094C is just ask for general information. Part 2 will be asking for a little bit more information, and that third bullet, certifications of eligibility, is a little tricky, so we'll talk about that. Then part 3 is the detailed monthly information that you're going to need to provide and put on the forms. And this I have highlighted because this is the section where, to make your life easier, I would be tracking this throughout the year to keep up. In other words, we've already been through January of 2016. So if you are want to be prepared for next year, for your 2016 reporting, I would go through and make sure I had all the monthly information for January 2016, and then do the same thing at the end of February and the same thing at the end of March, and so on. And then part 4, we'll talk about that a little bit more, but part 4 is a section that is just for those who are part of an aggregated group. That's the word that the IRS uses, and also known as groups that are part of a controlled or affiliated service group. So here's what the 1094C form actually looks like. You've got parts 1 and 2 on the first page. We have part 3 on the second page. And this is the section that I talked about where you have to gather. You can see you're going to be inputting monthly information here. And then part 4 is for aggregated groups. If you're not part of a controlled or affiliated services group, you are not going to need to fill this part out. Okay, so let's go through part 1. We'll kind of zip through this because it's super easy compared to the other things. You just need to enter your name as an employer, your EIN number, which you cannot truncate. You can't X out some of the numbers. You've got to put the phone number there. You enter your address and make sure it's the same address you're going to be putting on your 1095Cs for all your individuals. And then lines 7 and 8, you want to put a contact person and phone number of somebody there at your work that you trust to talk to the IRS. So if the IRS needs to contact you as an employer, this is going to be the point of contact, is this person you put here in this box. Lines 9 through 16, most likely, most of you will all be skipping. If you are not part of if you're not a government entity, you don't have to worry about this section. If you're a government entity but has not decided to have a designated governmental entity fill out these forms for you, then you can ignore this. The only reason you would use this section is if you are a government entity and you have decided to have a DGE or a designated governmental entity fill out these forms for you on your behalf. Now, the only difference in having a DGE fill out the forms for you versus a third-party entity or vendor is that those who are vendors or third-party administrators are not subject to reporting penalties. If you hire them to do it and they make a mistake, you're on the hook for those mistakes, not the vendor, not the third party. However, if you have a designated governmental entity doing the forms for you, they are actually subject to the information reporting penalty provisions if they mess up. They are not subject to employer shared responsibility penalties, of course, but they are subject to the reporting penalties instead of you as the entity. Okay. So lines 17, 18, and 19, really quickly. 17 is reserved. We can skip that. Line 18, enter the number of 1095-C forms you are attaching with this 1094-C. In other words, how many employees do you have to complete a 1095-C for and put that number in. Line 19, you're going to check a box if you are if this 1094-C is the authoritative transmittal. Well, what does the authoritative transmittal mean? Well, normally, most employers will be preparing one 1094-C. And if you're preparing one 1094-C, that 1094-C is called the authoritative transmittal. Simple as that. However, the rules do allow employers in certain circumstances to file more than one authoritative transmittal just simply for administrative ease. And if you file more than one 1094-C, one of them has to be the boss that completes all the forms, and the other 1094-Cs can just fill out the part at the top and then not fill anything else out at the bottom. So hopefully that makes sense to you. Let's give an example here on line 19. Acme Corp has 200 full-time employees. Division A prepares one Form 1094-C, which they've decided is the authoritative transmittal. There's nothing magical about deciding who gets to be the authoritative transmittal. You just decide. And 150 Forms 1095-C. They're attaching 150 1095-C forms because they have 150 full-time employees at that location. And it's easier for Division A to just fill it out for those employees at that location. Division B prepares one Form 1094-C as well. But this 1094-C is not the authoritative transmittal, or not the boss, or not the one that fills out the whole entire thing. And also files with it 50 Forms 1095-C. And they're filing 50 1095-C forms because there are 50 full-time employees at that location. So in this example, Acme Corp decided that it was easier for each division or location to complete the 1095-Cs for the employees that are at that location. So if that's the case, that's great. You can do that, and you both need to do a 1094-C, but one needs to be authoritative transmittal. And if you are the authoritative transmittal, you're going to go through the entire form and fill it out. If you're not, you just fill out through line 19, sign at the bottom, and you're done. You don't fill out any other parts of the 1094-C. You can just move right on to the 1095-Cs. The exception to this rule is, and it's an important one, if you are part of an aggregated group. Again, remember, an aggregated group is one of entities that are part of a controlled group or affiliated services group, and we talk about that in step 1 of our 4-step process for employer shared responsibility. So if you have questions about that, go back to your step 1. But if you are part of this, you don't get to share that, you don't get to have to deal with the authoritative transmittal issue. Each separate entity must file its own authoritative transmittal. You can't have one entity filing the authoritative one and everybody else does the non-authoritative one. So each individual one just files on its own and files its own authoritative transmittal. So, bottom line for line 19, just in case you're still confused, you're going to check this box if you're only completing one Form 1094C. Or you're going to check this box if you're filing more than one 1094C and the one that you have in front of you that you're filling out is the authoritative transmittal. So that's a check. You're not going to check this box if you are filing more than one and it's not the authoritative transmittal, like Acme Division B in the example on the prior page. And if you aren't filing the authoritative one, just again, like I said a minute ago, you're going to complete line 19. You're not going to fill it out. You're not going to check the box. You're just going to go to the bottom and sign and date, and you're done with the 1094C, and you can move on to the 1095Cs. Here's what the 1094C form looks like. We've looked at it before, but we've got part 1 and part 2, and now we've just completed part 1 and we're going to move on to part 2, and you can see if you're not the authoritative transmittal, after line 19 you skip parts 2, 3, and 4 and you go down to the bottom there and you can see signature, title, and date, and you're done with the form. If not, you're going to move on, which is what we're going to do, to part 2. So line 20 on part 2 is not a big deal, but sometimes can be confusing if you are filing more than one 1094C. So let's back up and say this. If you are only filing one 1094C, the number on line 20 is going to be the same number on line that's populated in line 18. If you are filing more than one if you're filing more than one 1094C, and obviously if you're the authoritative transmittal, because if you're not going to this section, the number on this line will be different than the number in line 18. So let's give you an example. And again, this only applies to those who are filing more than one 1094C. So Division A is the same exact example. Acme Corp has 200 full-time employees. Division A prepares one Form 1094C with the authoritative transmittal and prepares 150 Forms 1095C. And that is because they have 150 full-time employees at that location. Division B prepares one Form 1094C. It is not the authoritative transmittal. They stop filling it out after line 19, and they also complete 50 Forms 1095C for the representing the 50 full-time employees at that location. So, what do you do for the result on line 20? Only Acme Division A would complete line 20, first of all, because Division B doesn't have to do this section, and they would enter 200 because that's 200 total employees from both locations, the 150 at A and the 50 at B. For line 18, Division A would enter 150, and for line 18, Division B would enter 50. So hopefully that makes some sense to you. Okay, line 21 is super simple. Just check yes if you're part of a controlled or affiliated services group, also referred to as aggregated here on this line. If you check yes, just know as a heads up you're going to need to fill out column D on part 3 and part 4 on this same form. So we'll talk about that more when we get to it. Okay, line 16 on part 2 gets a little bit confusing, so we're going to spend just a little bit of time on this. First of all, we have box A, which is qualifying offer method, box B, which is the qualifying offer method transition relief for 2015, box C is the section 4980H transition relief, and box D is a 98% offer method. So we're going to talk about whether you should check. When do you know whether you should check these boxes or not? So Line 22, box A, qualifying offer method. Now we're not going to go over in detail what a qualifying offer is. Remember, you can refer back to the overview where we go into detail about a qualifying offer. But I've also listed the definition down below. But let's assume you've decided that you're going to use, that you qualify for the qualifying offer method and that you've decided to use it. So let's go through this. You're going to check this box if you offer to at least one full-time employee a qualifying offer and you intend to use this method. Remember, you may use this method for some and not all employees. You are not required to use this method even if you qualify for it. If you're not using this method, even if you qualify for it, you do not check the box, and it is not negative if you don't use this method. So, I have listed here as well the definition of a qualifying offer is stricter than an employer shared responsibility. That's what ESR stands for. Compliant offer because it requires, and then I review that again. So I have it here for you, but we're not going to talk about it since we've already talked about it and we're saving some time. So again, you do not need to use this method. If you want to use this method and you qualify for it, you may if you'd like. Here again is a reminder of the line that you're excused from populating if you do use this method. And here is box B. Box B, recall not recall. Do you recall qualifying offer method transition relief for 2015 only? We talked about that up in the overview when we were talking about alternative methods again. So you are going to check this box if you offered as an employer to a qualifying offer to at least 95% of your full-time employees. And remember, all that information is back on those slides, but I have the definition here listed below on the bottom dash. But let's review what you need to remember here. You may use this method for some and not all employees, although in actuality, I think if you choose this method, you would be using it for all of your employees because 95%, if you're offering a 95%, then you don't have to fill out line 15 for the other 5%. So if you're checking this box, you wouldn't be checking qualifying offer method as well. You're not required to use this method even if you qualify. If you're not using this method, even if you qualify for it, do not check the box. It is not negative if you decide not to use this method. Remember that the definition of a qualifying offer is stricter than ESR or employer shared responsibility compliant offer. And remember, if you need to remind yourself of this, you can go back to those slides in the overview, but I also have the definition listed on the prior page. How is this different from the regular qualifying offer alternative reporting method? Well, again, we discussed that on the prior slides, but just as a refresher, employees need not receive a qualifying offer for all 12 months of the calendar year like you have to under the regular qualifying offer method or box A. And you remember that if you offer to at least 95% of your full-time employees, you do not have to fill out line 15 for those 95%, nor do you have to fill out line 15 for the other 5% who did not get the qualifying offer. Normally you would have to fill out that line 15 for those 5%, but this excuses you from having to do that. And here again is the line, so you can visualize exactly what this excuses you from here on this 1095C. So box C is kind of a departure from the alternative reporting methods. Not quite sure why they put that right there, but right there rather than at the end of this list. But anyway, this box C deals with section 4980H transition relief. What in heaven's name, Susan, is 4980H? Well, 4980H refers to the Internal Revenue Code that deals with employer shared responsibility and all the rules surrounding it, including penalties. So there are several transition rules within the 4980H section that have to do with employer shared responsibility. Only 2 transition rules apply to this box C. And so it's important you understand what these 2 specific rules are. First of all, if in your step 1 that you did with us, your 4 steps to employer shared responsibility compliance, you were a size of 100 or more, you are just simply going to want to check this box. because basically what checking this box will do is tell the IRS that you are over 100 and that if you end up having to pay a penalty, you will be able to subtract, when you're calculating the penalty, 80 employees instead of subtracting 30 employees. Now, for those of you who haven't been through the employer shared responsibility seminars and are not well versed on how to calculate the penalties if you have a failure under employer shared responsibility rules, you may be confused by what I'm saying here. And if you are, let's make sure you get some access. Just ask us for the seminars or attend a live seminar that has to do with our 4 steps and the penalties under employer shared responsibility. But for those of you who are aware of this and aware that how the penalties are calculated, you know that one of the penalties allows you to subtract, is a per employee calculation, but you can, and normally you can subtract 30 from that. Well, in this case, for 1 year, you can subtract 80. So bottom line again, check the box if you're 100 or more in step 1. If you got in step 1 a result of between 50 and 99, you need to look and see whether you can qualify for this transition rule. And you were able to determine this specific transition rule in our step 2 of our 4 steps to employer shared responsibility. In step 2, it helps you determine when your effective date is under employer shared responsibility. In other words, when you are start to be exposed to penalties. If in step 2 you qualified for the transition rule that allowed you to not be exposed to penalties until 2016 instead of 2015, and this is not automatic for everyone who's between 50 and 99, as some people think. It's not automatic. You have to qualify for it, but if you do and you figured that out in your step 2, you can check this box. So if you don't remember what happened in your step 2, go back to your files that we had you keep on your step 2, and it will tell you what specifically your effective date is. If your effective date, again, is any time in 2016 rather than 2015, you're going to check this box. Now, if you check this box for one of these 2 reasons, under part 3, you're going to have to do another code, and we'll talk about that in a minute. But for now, that's all you have to worry about. Then our last box here is the 98% offer method. This is the 3rd of the alternative reporting methods we discussed in the overview. You may check this box if you're an employer who offered an ESR or employer shared responsibility compliant plan to 98% of your employees on whom you're reporting, in other words, to full-time employees. Reminders, just like the other ones, you may use this method for all employees. You are not required to use this method even if you qualify for it. If you are not using this method even if you qualify for it, do not check the box, and it is not negative if you decide not to use this method or if you do not qualify for it. It's no problem. So to qualify, remember, and we won't go over the details, you need to have offered an employer shared responsibility compliant plan to at least 98%. I have listed here what those rules are, but again, it's in the overview as well. So you're going to check this box if you are qualified for it and you are using it. If you do, remember, this is what you're excused from on part 3 of this same form, 1094C, that requires you to put in on a monthly basis what your full-time employee count was. And again, this is not a count that you can use your look-back cycle tracking to complete. You've got to do a separate tracking and determine which employees worked at least 130 hours in that month. Okay, so now here's part 3. I know we just had that on the prior slide, but we were talking about the 98% offer method. But now here's just the slide itself to show you now we're going to talk about part 3. And part 3, you recall that this is the section where you have to install or populate on information on a monthly basis. So there are 5 columns here, and they each require specific monthly information calendar year from January through the end of the year. Even if you have a non-calendar year plan, you've got to fill in calendar year information for 2015. Now, here's what we have done for you for this section. There are 3 columns here that are highlighted, and these 3 columns are kind of hard to keep track of. The other 2 you don't really have to keep track on a monthly basis. It's fairly easy to just go through at the end and fill out the D and E. But for A, B, and C columns, it would be highly convenient and helpful for you if you kept track of these throughout the year. Now, it's too late for 2015, of course, but for 2016, you're not too late to start tracking. We just barely finished January, and we have an basic Excel spreadsheet that you may use if you'd like, or you can come up with your own, that has all the employees' names down the one side, and across the top, you're going to fill out information for column A, for column B, and then column C. So really helpful, I think, for you to keep an easy way for you to keep track. Now, as we go through, and we'll go through each of those columns in detail in a minute, but first, before we do, there's 2 slides here that we need to discuss. And we need to discuss these 2 because they're important definitions for part 3. You need to understand what these definitions are and what they entail in order for you to understand these columns and how you figure out what to put in these columns. So the first one is Section 4980H, Transition Relief for 2015. Remember, we talked about this and for Box C, but only 2 transition relief rules applied to that Box C. There are actually more transition rules that have to do with 4980H. Remember, that's employer shared responsibility, and we have 6 of them listed here. So, when we talk about Section 4980H, Transition Relief for Part 3, which is the part we're talking about right now, there are 6 rules that apply. So here are the 6, and take time. You might want to pause this presentation right now and read through each of these 6 transition reliefs. Each of these 6 are discussed in our seminars and in our summaries about employer shared responsibility. So if some of these don't sound familiar, you may want to familiarize yourself again with your employer shared responsibility information that we've provided you, or that you can get from us. The second slide, or an important definition you need to understand for part 3, is a phrase referred to as a limited non-assessment period. Now, we talked about this once already before, but I didn't really go into detail about what it means. I said basically it's mostly, in most cases, like a waiting period. But there's more to it than that. It's basically a no penalty period, or a period during which you as an employer wouldn't be subject to penalties under employer shared responsibility, even if you have a full-time employee that was not offered coverage during that particular period. So a period that you didn't offer to a full-time employee, but that you're allowed not to offer to for that limited time, is called a limited non-assessment period, meaning they're not assessing a penalty during this limited period. I don't know why they just don't call it something simpler, but anyway, that's what we have to deal with. So we've got 6 different situations in which that fall under this limited non-assessment period. Take a moment to pause the slides now and read through each of these so that you understand what is part of a limited non-assessment period. Please note when you do that that an initial look-back measurement method is included in a limited non-assessment period. In other words, you're excused from not offering to somebody who's in their initial look-back measurement method, but note that there is no standard look-back measurement method here. In other words, if you have not offered to somebody who's in a standard look-back cycle, then it's not an excuse for not offering, and there's more details to that. So pause it now and read it and then come back. Okay, welcome back. So here we go. Column A, we're going to talk about each of the columns specifically now that we have those 2 definitions. You are going to check a box, yes or no. You're going to check it in all 12 months if the answer is the same for all 12 months of the year. Most likely it won't be the same, or maybe it will be. It depends on your situation. But You're going to mark the yes box or boxes if you can say that you offered minimum essential coverage to at least 95% of your full-time employees and their dependents. So, what are some rules about this? Employees that are in a limited non-assessment period, remember that was just on the prior page, basically certain waiting periods. There are a few other things you see if you read through that. It's not just waiting periods, but that is, you don't have to count them when you're calculating your 95%. Also, if you did not offer 95% to all your full-time employees, you can still mark yes for 2015 for that particular month if you offered to 70% instead of 95%. So in other words, in our seminars and in our materials for employer shared responsibility, you learned that for 2015 only, instead of having to offer coverage to 95% of your full-time employees like you will have to in the future years, you only have to offer to 70%. So again, you can mark yes in the yes boxes for the months where you offer to at least 70% or more of your full-time employees. Every other year, it will have to be 95%. Okay, column B, you need a full-time employee count. And again, we've talked about this because this is the column that is for that you get excused from filling out if you are using the 98% offer alternative method. So let's talk about how you do this or what the rules are. You're going to enter just the full-time employees for each month. In other words, anyone who worked 130 hours or more in that month is counted in the number that you install in this box. When you are making this count, you do not have to include those who are in the limited non-assessment period. Remember, 2 slides back, if you have somebody in that count that fits into one of those limited non-assessment periods. Again, it's a period of time where you didn't offer coverage, but you're not assessed or exposed to penalties because you have a specific rule that you're complying with that gives you an excuse not to. So, you don't count those. An employee that is full-time for a month, if worked an average of at least 130 hours in that month. Again, we said this before, but just understand that they have anybody, even if they're not typically somebody you consider or classify as full-time, if they worked 130 hours in that month, then you do. Count them in your count. And again, you do not complete column B if you qualify for the 98% offer method. And I neglected to say on the prior slide that if an offer of coverage is only counted, and you probably read it when you looked at the slide, but is only counted if they get coverage for the entire month, for the beginning of the month through the end of the month. And now I'm talking about column A. Again, you can only count that month if they were eligible, whether they opted in or not for coverage for the entire month. Okay. What's the common confusion that applies to column B? We'll have a few slides that have to do with common confusion. We've talked about this briefly, but I'm going to say it again because it comes up a lot. Calculating full-time employees by month for column B is different than identifying whether an employee is full-time and eligible for coverage under employer shared responsibility, and specifically using the look-back measurement method. Under the look-back measurement method, an employer may average hours over an up to 12-month period to identify full-time employees. However, under the information reporting, an employer may not average hours over a 12-month period. Instead, an employer reports how many employees were full-time for each individual month, meaning 130 hours or more worked in that month, worked or hours of service in that month. Therefore, it is possible that an employee who is not eligible for health coverage under the look-back measurement method due to averaging hours over 12 months is still counted as full-time in this column for certain months of the calendar year, due, for example, to a variable hour schedule. Okay, we've talked about column A and column B. Let's talk about column C. This one's super easy compared to the others. You're going to enter the total number of all employees for each month, whether they're full-time or not. Basically, you're counting belly buttons. You don't have to exclude those who are in a limited non-assessment period. In fact, everyone is counted, even those who are in their limited non-assessment period or a waiting period. So You're basically counting belly buttons. The only thing you have to understand that you have to count belly buttons on the same day every year. It can either be the first day of the month, the last day of the month, the 12th day of the month, the first day of the payroll period, or the last day of the payroll period. So what's the common confusion that happens on column C? Well, include all employees in this count, whether full-time or not. In other words, you include all full-time, all part-time, all variable, all seasonal, all contingent employees, all employees in a limited non-assessment period. The only exception are employees who, for any month in this year, calendar year, are on TRICARE or VA, veterans coverage. And the other confusion that happens on column C is that calculating the total monthly employee count is different than calculating employer size under employer shared responsibility step 1. So remember, we've talked about step 1 a lot. In step 1, we have you do your official calculation using an Excel spreadsheet that we provide to you. And you have to go through a certain way of calculating, and you're also calculating full-time employee equivalents. You're not dealing under information reporting with full-time employee equivalents. Again, you're just counting belly buttons. So it's much simpler in column C than you have to deal with in step 1 of employer shared responsibility. Column D, super easy. All you're doing is checking the box if yes, and leaving it blank if no. Complete this column only if you checked yes in part 2 on line 21, meaning, remember, that was the line that says, are you part of an aggregated group, or in other words, part of a controlled or affiliated services group. Remember that an aggregated group refers to a controlled or affiliated services group, and if you're confused about this, refer back to our step 1, which is where it's all explained and where you determine this. So column E, this column is super easy. Well, not super easy, but much easier, not very technical. Remember back in section 2 on line 22 where you had the 4 boxes. You had box A, box B, box C, and box D. And box C was that funky section that talked about 4980H transition relief. Well, this is, and you had 2 situations in which you might qualify and check the box. This is the section of the form where you're going to say which one you qualified for. In other words, if you got, in our step 1, a number of employer size of between 50 and 99, and in step 2 of our process, you have an effective date that is sometime in 2016 instead of sometime in 2015, you are going to enter code A on this line for each month that applies. If you are over 100, you're going to enter code B. And remember, this is not the non-calendar year transition rule for those who are over 100. It is simply the rule that allows you to subtract in case of a possible penalty. You're going to subtract when you're doing the calculation for the penalty. You're going to subtract 80 of your employees instead of 30. Now I'm getting everything all confused. So, okay. Part 4, again, is only filled out by those who are part of an aggregated large employer group. In other words, those of you who are part of a controlled or affiliated services group. And this is what it looks like. So let's talk about it in detail. Remember back in part 2, line 21, you checked a box, and just now in part 3, you filled out column D that said that you were part of an aggregated group. So if you checked any of these boxes, you've got to complete part 4, and you're simply going to enter the name and EIN number of each of those individual entities that are part of the control group. Now, what you do actually is, some have asked, well, what if okay, let me back up. When you enter the names on these lines, you're going to enter them starting with the largest entity first and ending with the smallest. And you're only going to enter the top 30. The top 30 largest. If you have more than that, you can just forget about the other ones. If you have less than that, you're just going to enter all of them. But you're going to start with largest and end with smallest. How do you determine size for this particular part 4? Size is not the size you were in part 1 because that was aggregated all together. What you do is you're going to look at what you put, the number you put in column B. Part 3, column B, remember that was full-time employee count per month. And the size of each aggregated group is determined by the highest monthly average number of those full-time employees entered in that column B. So you're going to look at all 12 months, the number that was entered in all 12 months, and add those all up and divide by 12, and that's your average. And the entity that was the largest would go in first. Okay, so that is the end of our 1094C section, line by line. We are done with 1094C. That one takes a lot longer to explain than the 1095C does, but because it has a lot more parts to it and it gets a little bit complicated. Now, 1095C gets a little complicated too, but it's just one page. And this is our overview. We have part 1, employee and employer information. Part 2 requires specific monthly information about coverage offered to each employee. This is the monthly tracking part. And then part 3 is only for self-insured plans. So if you're not sponsoring a self-insured plan, you don't even have to worry about part 3. You only have parts 1 and parts 2. Okay, so this is what the 1095C looks like. We've looked at it before because we were looking at line 15, but it's just one page. Let's talk about part 1 really quickly because it goes really fast. Enter employee's name. You must enter the Social Security number. You may truncate the Social Security number if you like, but you do not have to. And then of course their address. And then we have lines 7 through 13. That's all information about you as the employer, your name, your identification number. That cannot be truncated. You've got to fill that out completely. Your address, make sure it's the same address you used on the 1094C. Enter the telephone number of the contact person the employee can call. Remember, this is the form that goes to your employees. So the number here, if you're part of a large organization, will be the number that this person thinks that they need to call if they have any questions to ask. And then lines 11 through 12 and 13 are just city, state, and country. Okay, so again, this is what it looks like, 1095C, and we're going to move on now to part 2. So first of all, right above lines 14, 15, and 16, we have plan start month that's highlighted. This is new to the forms when they issued the final forms last fall. And you do not have to fill this out this first year, but you certainly can, and it's certainly not difficult. You just enter the plan start month. So for example, if your plan starts in October, you would enter 10. If it starts in May, you would enter 05. If it starts in January, you would enter 01, and so on. It will be required next year. So let's move into this section. This section is where you this is your monthly tracking again. So line 14, line 15, and line 16. These are the sections that you would use our Excel spreadsheet for as well. So our Excel spreadsheet that I talked about before that covers those 3 columns also has these 3 lines on it, so that at the end of every month you can enter in this information and this coding, and you automatically have it at the end of the year, and you don't have to try searching and looking for it all over in various places. So again, if you'd like a copy of that Excel spreadsheet and you don't want to make your own, you're certainly welcome to do that. It doesn't populate any forms for you. It's just a means of tracking. So line 14 is whether an employee was offered minimum essential coverage, and you have to report that on a monthly basis. So you're going to populate this box with Series 1 codes that indicate the type of offer that you made. Now remember that you may only count as an offer that would have covered the entire month. So in other words, again, an offer of coverage is one that they would be eligible for or on if they opted in for that entire month, from the first of the month to the end of the month. So for example, if you offered somebody coverage and they're not eligible or not actually on until the 15th, you could not count that month as an offer of coverage. So here are the codes, and you'll want to pause this in a second to read through all these codes so you can familiarize yourself with these. But the thing that I want to point out on this slide is the 1A, which is by far the most asked about code. And this is because of the common confusion that happens with this qualifying offer. And we talked about this in the alternative reporting methods. A qualifying offer does not mean that you are offering a plan that meets employer shared responsibility rules. A qualifying offer is a specific definition under information reporting that is stricter than employer shared responsibility rules. So, and again, we have those other slides that you can refer back to refresh your memory on what a qualifying offer is, but do not enter code 1A unless what you've actually offered is a qualifying offer and not just an employer shared responsibility offer that complies with an offer that complies with employer shared responsibility. There is absolutely no problem or no issue or no worry if you cannot enter 1A. If you offered a qualifying offer, great. If you didn't, but you offered and it meets a 1B, 1C, 1D, or 1E, then you're fine. You don't have to worry about that. So take a moment to pause and read through each of these codes. Okay, here's the common confusion about line 14, and I've already talked about it because I got a little ahead of myself, but this is the deal. Code 1A cannot be used unless the individual received an actual qualifying offer as defined by information reporting rules. A qualifying offer is stricter than an offer that complies with employer shared responsibility. Extra requirements, again, are it must be offered to the spouse. Under employer shared responsibility, it doesn't have to be. And it must meet federal poverty level affordability safe harbor. And under employer shared responsibility rules, it doesn't have to be a FPL. It can be W-2 method or rate of pay method. Is it bad if an employer cannot put 1A in line 14? Absolutely not. Codes B, C, D, and E are all equally acceptable. And again, I've repeated that twice just because it is one of the most common questions, and I want to make sure that you're not making a mistake and putting in 1A when you didn't actually offer a qualifying offer. So when does an employer use code 1G? 1G is for employers who sponsor a self-funded plan. So, and there are other rules, but notice you don't even pay attention to that unless it's self-funded. When does an employer use code 1I? Code 1I is used for the 5% of full-time employees who are not offered coverage under the qualifying offer method transition relief. Well, it could be for all of them, but anyway, that's what you use that code for. And then 1H, of course, is, which I don't have listed here, is no offer of coverage. So line 15, what's the information we enter here? That we enter here the employee's share of the lowest cost single coverage that was offered that meets minimum value by month. So in other words, you are going to put in the cost here of what you would charge of the lowest compliant employer shared responsibility plan. So here are some rules to remember. Populate a month on this line and put actual numbers or a dollar amount on this line if in line 14 you used 1B, 1C, 1D, or 1E. You're going to leave line 15 blank if on line 14 you used code 1A, 1F, 1G, 1H, or 1I. So leave the entire line blank if you are using the qualifying offer method or alternative method for reporting or the qualifying offer method transitional relief. So in other words, you can use 1A for individual months and then not have to fill out that one individual line month for cost. But if you are using the actual alternative methods, one of these two that are listed here, you just leave the entire line blank. So you're going to enter the lowest cost for single coverage offered. This means an employer may need to enter a number that is different than the cost of coverage that a participant is actually enrolled in and paying for. For example, if a participant opted into a more expensive plan, an employer would still enter the cost of the least expensive plan, again for single coverage, not family, that meets minimum essential coverage and minimum value. Okay, moving on to line 16. Line 16 is the line where you indicate your reason for, in most cases, your reason for not offering coverage. It's sort of your excuse for not offering coverage even though they were full-time. So technically, you're going to use a Series 2 indicator codes, which we have on the next slide. But first, before we go there, technically you're not required to enter a code here, but I would enter a code here that indicates the reason that you did not offer coverage. Now, if there is a code that does not apply, you must leave it blank. That may indicate that you are exposed to penalties, but it may not. It depends on the situation and the codes used above. But just understand that you are going, despite these rules, you're going to want to enter the codes that apply. Okay, so this is the slide that is a summary of the code Series 2 indicator codes, the Series 2 indicator codes. Now, I need you to understand that this is a summary of the codes. When I listed the slide that says Series 1 indicator codes, that was word for word what's in the instructions for the forms. But on this one, there's a small paragraph for each of the codes that gives a little bit more information that you're going to want to be aware of. For purposes of the slide, I summarized it, and for your cheat sheet, I summarized it as well. When you become more familiar with it, it'll be easier to use this than a list with the entire paragraph under each. We have a document that you can ask us for that lists, that has word for word each little paragraph for each of the codes. So you're going to want to ask us for that so that you have access to that. And so if you have a question about whether a code applies or not, you can read the entire paragraph, which will help you determine whether it's an appropriate code or not. Okay, so take a moment to pause this, to look through the codes and be familiarize with each of the codes. Okay, let's talk about common confusion about line 16. What code applies if an employee is offered coverage but opts out and does not enroll? Very, very common question I've been getting lately. So check what, this is the easy way for you to understand what you do. I keep referring to the 4 steps that you did with us. When you go through the 4 steps, you went through step 3, which part of which helped you determine which affordability safe harbor you chose or you want to use for your year. If you chose in step 3 the W-2 safe harbor, you're going to enter code 2F if an employee is offered coverage but opts out. You don't put 2C because 2C means they enrolled. 2F is they were offered but they opted out, and our affordability safe harbor is the W-2 safe harbor. If you chose a federal poverty level safe harbor, in that same circumstance, instead of putting 2F, you're going to put 2G. They were offered coverage, they opted out, and our affordability safe harbor is federal poverty level. Same thing with rate of pay. 2H, if they were offered coverage, they opted out, your affordability safe harbor in step 3 was rate of pay, then you're going to put 2H. And of course, here at the bottom of the slide, if the employee opted into coverage and they actually enrolled, your code is going to be 2C. Okay, another commonly confused point on line 16 is any waiting period or any look-back measurement period cycle considered a limited non-assessment period in Code 2D. In other words, Code 2D lists all the limited non-assessment periods that we talked about in our definitions earlier on. And I've already talked to you about the fact that no, not every waiting period or look-back measurement period is included in this code and is an excuse for not having offered coverage. Being an employee in a standard look-back measurement period is not somebody you could use a code 2D for not offering coverage. You can use 2D for someone who's in their initial look-back measurement period, and you can use someone who is in their 90-day waiting period, but not for somebody who's in their their standard look-back period. Okay, so Common confusion about line 16 continued. There's a lot of confusion on this line, as you well know. May an employer use code 2B if the part-time employee was not offered coverage? Yes. In my cheat sheet for the Series 2 codes, we talk about the fact that it's a little confusing how we worded it earlier. But basically, if you have a part-time employee, whether or not they were offered coverage, you can use 2B. May an employer use code 2A if the employee worked only a couple days in the month? 2A is they are not an employee for that month. But code 2A is only for employees who did not work any day in that month. So even if they worked one day in that month, you cannot use 2A. When may an employer use code 2I? 2I is the code that applies to those who got 100 or more in step 1 in our 4-step process and who in step 2 qualified for the non-calendar year transition rule for 2015. If you have not gone through the steps, you will not know what I'm talking about, maybe, likely. But if you have and you don't remember, refer back to step 2 and look at when your effective date is. If your effective date, if you're over 100 and your effective date is anything other than January 1 in 2015, then you qualified for that. And you can use 2I as an excuse for not offering coverage during those particular months because you're not exposed to penalties. Okay, let's do some examples. We're going to have 3 examples with 3 slides. Example 1. Betty, her spouse, and her dependents received an offer of health coverage that met the definition of a qualifying offer. Now, we're not going to review again what the definition of a qualifying offer is. Just know that she got a qualifying offer, and so did her dependents and her spouse. She was offered this plan from January through December of 2015. So in line 14 in the all 12 months box, because it was the same for all 12 months, if it was different for some of the months, you couldn't put it in obviously in the all 12 months box, but you're going to enter code 1A because she actually got a qualifying offer. On line 15, you're not going to enter anything because if you use code 1A in line 14, you can leave line 15 blank. And for line 16, 2 codes technically apply. You've got an employee, 2C is the employee enrolled in coverage, and 2G is the federal poverty line safe harbor for affordability. Well, because she opted in, you're going to use 2C. Now, if she had opted out, you would use 2G. So hopefully that makes sense. Example 2. Grace was hired in January and she and her children, but not her spouse, received a minimum essential coverage and minimum value offer of health coverage after a 2-month waiting period, and that waiting period was January and February. Grace could select from 2 plans. The first would cost her $95.05 per month for single, and the second would cost her $125 per month for single. Neither exceeded 9.56% of her income, meaning it was affordable. She opted into the second plan, the one that was more expensive, but selected a family plan instead of single. So instead of $125, it cost her $243 per month. So how does she fill out the form? On line 14, for January and February, you're going to enter 1H. 1H because she was not offered coverage. She was in her waiting period. On line 15 for January and February, because you entered 1H, that is one of the codes where you don't fill out the dollar amount. That is because for this case, it's logical because there was no offer, so there was no cost. So that is left blank. And then line 16, you would enter 2D. Now recall 2D, if you want to stop it and look back at your codes, 2D is the one that the excuse for not offering is in their limited non-assessment period. And one of those is the 90-day waiting period, which she was in for January and February. So that applies. Now for March through the end of the year, back to line 14, you're going to enter 1C. That's because That offer was because a spouse was not offered, so 1A doesn't apply. So that's the code that says that she was offered plus dependents were offered but no spouse. So that's 1C. In line 15, you're going to enter $95.05. That is because that was the lowest cost coverage for single. It's not the amount she's actually paying, but it's the amount that was offered that meets employer shared responsibility. And then on line 16 for March through December, you're going to enter 2C. 2C is that she enrolled in coverage, and therefore you would enter that. Now, if she had opted out of coverage, that would be a different rule. It would be apply, a different code would apply. Okay, last example, John. John received no offer of coverage from January through March. A different reason he didn't offer coverage than Grace before. John wasn't offered coverage because his employer qualified for the 2015 non-calendar year transition rule. So they're over 100. They qualified for the non-calendar year transition rule and therefore are not exposed to penalties until April. Starting with April, John received a qualifying offer, and remember, this is not an employer shared responsibility compliant plan. It's more strict than that. It's compliant under employer shared responsibility, but it's also even more strict than employer shared responsibility. And he got it for 12 months, and he opted into coverage. So how do we fill out the form? So for the first, on line 14, for the first 3 months, you are going to enter 1H. That is no offer of coverage. On line 15 for those first 3 months, you're going to enter no dollar amount, because when you ever enter 1H, you don't have to enter a dollar amount. And then on line 16, you're going to enter code 2I. That is the special code just for those employers who qualified for the non-calendar year transition rule. And it applies for January, February, and March. That means this employer is not exposed to penalties until April of this year. And that code 2I explains that. So even though they didn't offer coverage, this employer is not going to get in trouble or a penalty for failing to do so. Now let's go back up to line 14. For April through December, because he was offered a qualifying offer, and it was technically a qualifying offer, you put in 1A for the remaining months. Again, on line 15, you leave that blank, because if you enter code 1A, you don't have to fill out line 15. And line 16, he enrolled in coverage, so it's 2C for the remaining months. Okay, let's talk about a few more things before we close. We've got some special situations on the 1095C that has created some confusion, and then we will talk about our last section, which is next steps. So the first confusion is COBRA, and I will tell you, COBRA has been super confusing, and it is still super confusing, and in some cases the rules contradict themselves. So what I have here on the slide is our current understanding of what we think those rules mean, and it may change when they clarify better in the directions at some point or in the regulations. So this is our current understanding now. We have to, let me back up. There are a lot of different situations with COBRA, so we're going to divide it out into 2 sections right now. This slide has to do with an offer of COBRA to a current employee, and the next slide is going to refer to an offer of COBRA to a non-employee or a past employee. Okay, but first, an offer of COBRA to a current employee. So this slide. First of all, I want to give you an example of what an offer to COBRA to a current employee might entail. What would bring up that situation? Why would you be offering an offer of COBRA to a current employee? Well, a full-time employee might change positions, change to a part-time position, resulting in a loss of coverage, or a variable hour employee who averaged full-time hours in one measurement method, but in the following measurement method averaged less than full-time. So they lose the eligibility even though they are still an employee and still variable. So here's the rule. It's a lot easier than the next slide. You basically report like you would as if they were on normal coverage. So in other words, you report on line 14 that they received an offer of coverage, whatever offer of coverage is applicable. The only difference is on line 15, you would enter the dollar amount for the COBRA cost rather than the dollar amount that is under the regular group plan, which will always be different, I would imagine. Almost always be different. If you're self-funded, remember that employer also needs to complete Part 3 of the 1095C, and we'll talk about that in a minute. So that's COBRA. Oh, we talked about that already, sorry. So Part 2 still, sorry, we didn't talk about Part 3 yet. We will in a minute. Part 2, again, COBRA. This time an offer of COBRA to a former employee or a non-employee. We've got 4 different categories, and I'm not going to take the time to read each of these and explain them, but the point here is to illustrate that there are a huge variety of situations in which you're going to have to be dealing with COBRA. And we've tried to summarize them here for you so that it makes sense. If you have any questions, let us know. If we get any clarifications, I will let everyone know, and I'll update this seminar. So I'm just going to read the 4 different categories. So you have an offer of COBRA where only the individual enrolls in COBRA. We also have an offer of COBRA where the individual plus dependents and or spouse enroll. We also have a situation where neither the individual nor the dependents and nor the spouse enroll in COBRA, or if the last situation where the individual does not enroll but their dependents or their spouse or their ex-spouse do enroll. So you've got different situations and ways to report depending upon depending on the specific circumstances for that specific employee. And here, as I promised, we were talking about Part 3. I misspoke and said we're done with Part 3, and we're not. So Part 3 is super simple, and we'll spend 2 seconds on it. But Part 3 is only for employers who sponsor self-insured coverage. You may skip this section if you sponsor a fully insured plan and not self-insured. If you are offering a self-insured plan and if that particular individual enrolled, you're going to check that box there at the top just above line 17 and above the chart. If they, in other words, if they were offered but they did not enroll, you don't check the box and you don't fill out the section. Must complete Part 3 for any employee working any month of the calendar year who elects coverage, even if not a full-time employee. In other words, if you sponsor a self-funded plan and you offer to more than full-time, you need to report on them as well here. It's a part-time employee and you offered coverage and they enrolled, you've got to complete the form for them. Do not complete this section if coverage is offered under a multi-employer plan. That's not most of you, but I put that in. Okay, so Part 3, columns A, B, C, and D and E. So all individuals enrolled in self-insured coverage to the employee must have columns A, B, C, and D completed. So you make sure you also include the employee, the spouse, and all dependents. Column A, you just simply enter the name of the individual. Column B, you're entering the valid 9-digit social security number. You need to have the social security number here, or if you don't, for the dependents of the spouse, you can enter the birth date, but it's better if you have the social security number apparently. Check the box in column D if it was all 12 months. If not, you've got to check each individual month in which they were enrolled in coverage. If you run out of lines, meaning if you have more than 6 covered individuals, you're going to need to get a copy of the continuation sheets and make sure you fill it out for everybody who's on. Okay, here is an example. The health insurance ACME offers is self-insured. So ACME must complete this section, and they must complete it for Grace because she enrolled in coverage. So she opted in the coverage that was offered, that was for the full calendar year, and also put her 2 children on who are dependents under age 26. Coverage was not offered to her spouse. So on line 17, you're going to enter Grace's information, her social security number, and that she was covered all 12 months. And on lines 18 and 19, you're going to enter her 2 children, George and Georgiana. Yeah, I know, kind of not very original, but Anyway, there are social security numbers as well. If for some reason you don't have them, you put in their birth dates. If they weren't covered all 12 months of the calendar year, remember it's calendar year, you need to distinguish that within the monthly calendar boxes. Okay, how to deal with non-employees who offer coverage. In other words, on Part 3, and you offer a self-insured plan, and you offer to a few people who are not actually technically employees, then you still need to fill out this part. In other words, what's a non-employee? Well, a non-employee director is an individual who's retired employee during the entire year, a terminated employee receiving COBRA, a non-employee COBRA beneficiary, and so on. So again, if you have somebody to whom you've offered coverage and they're not an employee, you still need to fill out a form, specifically this Part 3 section. If you have an insured plan, again, you do not need to worry about this section. If you have a sponsor a self-insured plan, you are required to report. You actually can technically use the B forms because the B forms are just almost identical to what this section, Part 3, is for 1095C. But for convenience, the IRS added this section to the end of the 1095C form. So I think it's just easier to just use Part 3 of 1095C rather than do a completely separate form. Remember, you must include the Social Security number for this non-employee under Part 1. You absolutely have to enter it. If you don't have the Social Security number for this person who's non-employee, you must use the B form instead. You don't have the option to use the C form. Under Part 2 for this non-employee, use code 1G in the L12 months box indicating they were not an employee for any month of the calendar year. And under Part 3, all non-employee members who are covered individuals must be included as well. Okay. Another complication or question that's come up is how to deal with HRAs and whether to complete Part 3. And that's come up mostly in the setting where we have somebody who has a fully insured group health plan but has a self-funded HRA. If a large employer with a fully insured group health plan and a self-funded integrated HRA, what do we have to do? Because we technically have a self-funded plan, do we have to fill out Part 3? The answer was different a little while ago, but with the final directions or final instructions, they changed it so that you now do not need to fill out Part 3 if you are in this situation. However, there is an exception. The exception is that you do need to fill out Part 3 for an employee if the HRA is integrated with another group health plan. In other words, the HRAs typically are integrated with your actual own group health plan to help cover costs. However, some employees in some situations at some employer locations get that HRA money, but it's integrated with a spouse's group health plan. So it's not integrated with you, the employer's health plan. If that's the case, you do need to fill out the Part 3 for that particular individual who has their self-funded HRA integrated with a separate health plan that is not yours. Okay, we are in our last section, hurrah. We have just a few minutes left before our 2 hours are up, and we have our next steps. So, Susan, you've taught me all this stuff, and my head is swimming, and I don't even know where to start. So, this is where you start. Number 1, first checkbox, complete GBS 4 steps to employer shared responsibility compliance. As you could tell throughout this presentation, the 4 steps is really important in order not only to prepare and make sure you're in compliance with employer shared responsibility, but it also magically helps you prepare for information reporting. So during this 4-step process, don't skim. Make sure to learn and understand the rules under each step, and make sure you stay up with it and understand that employer shared responsibility is not information reporting. Each has a separate ACA provision with separate penalties, but they do dovetail, obviously, because under information reporting, you are reporting on what you do under employer shared responsibility. So that's the first step. Very important. Get on that right now or finish it up right now if you are stuck somewhere in the middle of the steps. Number 2, understand the difference between information reporting rules, tracking, and reporting methods, and employer shared responsibility rules, tracking, and measurement methods. So basically here is, it's important to kind of keep in your mind separately employer shared responsibility rules and separately information reporting rules, because a lot of confusion happens if you start mashing those together. And the way you do that, by the way, I know I moved on to the next slide, but the way you do that is to just stay up to date, come to our seminars, read our summaries, whatever it is. If you don't know how to get up to speed on that, ask us. We will give you some information or give you some ideas and tell you about the next seminar or give you a link to a seminar that's recorded or whatever. The third thing is select the information reporting method that you will use, if any. In other words, we talked about the alternative methods, we talked about the general full methods. Decide what you're going to do and then identify which data you do and do not need in order to collect it and actually report. The next step is determine and understand who is populating your forms, who is submitting your forms, and who is delivering, we need to add this, who's delivering the forms to your employees. So we're going to talk about this for if you're doing this in-house, and then we're going to talk about this if you're doing this with a vendor. So if you're completing in-house, obviously you're doing all these steps. You're populating the forms, you're submitting to IRS, and you're also providing to your employees. Make sure you set up your technology or process for monthly tracking, whether you use our basic Excel spreadsheet for tracking the 3 categories on the 1094C and the 3 categories on the 1095C, or whether you come up with your own or have your own method for doing that. Just make sure you do it. If you do it and keep up throughout the year, your life will not be miserable like it was for many of you trying to figure this out now for this year. So for next year, make it a little bit easier on yourself and keep up throughout the year. Be clear on the reporting rules as you populate the forms. Check for accuracy. If you have a question, check it. Don't just guess and move on. Sign up for the AIR system, the AIR program, to submit the forms to IRS if you need to or if you want to. Again, you're required to if you have over 250, or you may voluntarily do so. We have, like I indicated before, a new article that's February 2015 that goes through more detail on the steps and how to figure out some of the steps. We had an older article that didn't provide more detail just simply because we didn't have it, but now there are kind of, you can divide the steps within the AIR system into 3 basic categories, and we walk you through those and help you understand a lot better how to go ahead with that process. Determine and understand who is populating your forms and who is submitting, and I'll add here too, and submitting to IRS and providing to your employees. So that's the third thing that should be underlined. And this time we're talking about a vendor. We just talked on the other slide about you as doing it alone. If you're using a vendor, the number one important thing you need to do first off, which is the problem we have seen, is you need to communicate with your vendor or your third party and make sure you absolutely both understand who is doing what. Is your vendor tracking for you and populating the forms, but then you're submitting to the IRS and to your employees? Or are they doing everything or something in between? So I know there's been a ton of confusion. Make sure you communicate that and make sure you're on the same page so you're not left at the last minute thinking they're submitting and you have to figure it out on your own and do it. Provide your vendor with your 4-step results. Don't let the vendor change your step 4 decisions. In other words, they have made some decisions as vendors for what you should do for your 4-step process. If they're doing vendor, the 4-step process that you complete on your measurement method policy in step 4. Their suggestions are based on what was easier to create, their IT people to create to make their system run better. It was not based on convenience or administrative ease for the employer. They just simply weren't, in most cases that I understand, simply weren't even aware of many of the details of these rules. So we walk you through those 4 steps, keeping in mind that we're trying to help you come up with a policy that is easy for you to administer and manage. versus one that's just basically thrown out there by some people who don't fully understand the rules. So once you complete your 4-step process, make sure that you are sticking by those and letting the vendor know what you've decided to do and not going with their suggestions. Request also from your vendor a full test run. In other words, you want to ask them to give you a test run of how they would code all the boxes and what they would do for all the lines and columns. This is because, well, you should do this anyway, but this is particularly important this year because we have yet to see a vendor who's doing everything correctly. Everybody's struggling to get up to speed with this and figure out how to do this correctly. The vendors are, and so you need to, and the vendor's not going to be on the hook for inaccurate information. You are as the employer, and this is the year to learn. So ask for a test run, go through how they propose they're going to fill out the forms, and correct them if you need to. If you are considering a vendor and you haven't gotten one yet, there was a time we said it's too late for 2015. It's not necessarily too late anymore because of the extended deadline. Contact Ken. Specifically, he has a pre-selected list of vendors with preferred pricing and also can provide and answer basic questions on their services. And he also keeps track of the current market pricing and can advise when a vendor or system offering an ACA support system is outside the line and can provide insight on questions that may need to be answered or determine why and if a reduction can be negotiated. So that can prove to be a huge help to you should you need that. Determine exactly where the information will come. Meet all the parties who have all the relevant information to discuss processes and locate the data, and do this in advance. I know it's too late for advance for 2015, but do it in advance for 2016 and then just do it as quickly as you can for this 2015 if you haven't gathered that yet. Keep up each month with your tracking and collecting data. I've already talked about that before, and you can use whatever process you want, whether it's our basic Excel spreadsheet or something else. Make sure you submit the forms on time. Do not submit late. There's a separate penalty just for being late, just like there's a separate penalty for not filing electronically if you're supposed to. And then, of course, keep learning. Stay up to date. There will always be updates, clarifications, or changes, and you need to be aware of those. And here are some resources that you can go to get more information. And that concludes our seminar for today. If you have any questions, make sure to contact us. And hopefully you found this helpful. And again, please make sure you attend any future ones to stay up to speed on any changes or updates. Thanks so much.